You can't wait for 10 years for every goal. Any money which you require for next 3 to 5 years should not be in equity. At any point of time, you should have your 1 month expenses in a savings bank account. Obviously, you should not be spending money from credit card without having that money in your bank account. If you already have a health insurance, then that takes care of your cashless part of it. Now, your FD interest and a debt fund interest, right? Both are taxed at your tax slab. If your limit is say 3 lakh rupees, I'll say always give 50 to 60,000 rupees amount which is not used, so that can be used in case of emergency. SIP in liquid fund is one of the best way to have a forced saving.
You're losing money if you're keeping it in your savings bank account. This is something that you've probably heard in the past few months. And that's because a lot of banks, big banks, have cut the interest rates on these accounts to 3% or less. In fact, State Bank of India is at 2.7%. The argument is a fair one. If you account for the tax that you pay on this interest, you're nowhere close to beating inflation. But it's not as simple as that. In fact, one of you pointed out in the comment section of an earlier video that I did that in emergencies, having money in your savings bank account can literally be a lifesaver. I want to talk about this today. For years, we've been conditioned to managing our money in a certain way. And while a lot of times we speak about the benefits of saving for long-term goals by investing in equity, we don't necessarily spend enough time talking about how to manage money that is meant to take care of emergencies or even short-term goals. Is there a way to use systematic transfer plans and systematic withdrawal plans without complicating things? This is MoneyWise on NDTV Profit, and I'm Alex Matthew. On today's episode, we're going to discuss the most efficient ways to manage your short-term money requirements and cash flows. Joining me today is Nikhil Kothari, Director of Etica Wealth Private Limited. Nikhil, thanks so much for taking the time.
Thank you, Alex. Thank you.
So over the course of this conversation, I'm hoping that we're going to give people a blueprint of how to manage their money on an ongoing basis, because a lot of goals that they have are recurring goals. Say, for example, a vacation that they want to take their kids on every year, or even an emergency corpus, or even a short-term goal like school fees. You can't put that in equity. But first, let's address the whole savings bank conversation, because I made this statement. It's criminal to keep your money in your savings bank account. And mathematically, it sounded okay, but somebody pointed out that they went through an emergency, a medical emergency, where they couldn't access their funds, they couldn't access their mutual funds, and their partner and children were not able to do so either, and they were in a bit of a fix. So how do you think the best way to handle something like this is?
Yeah. So, Alex, as you rightly said, that at any point of time, you should have your 1 month expenses in a savings bank account, right? Because for any emergency happens, you need to immediately withdraw the money. So that money is available to you in your savings bank account. But money which you require beyond 1 month expenses, right? Keeping in savings account doesn't yield you anything, right? And your money is losing out in terms of interest. So ideally, that money should be kept in liquid fund, right? And in liquid fund, you can withdraw the money in 1 day's time. So if you give them instruction today, next working day, the money is in a bank account. So it's not illiquid. It's available to you at any point of time.
So, but liquid fund, sorry to cut you, but liquid fund is only one option. There are several options for you to consider in this, and we'll get to that in a bit. But essentially, you're talking about not a savings bank account, an alternative in the mutual fund space.
Exactly, right? So you keep your 1 month expenses in savings account. Beyond that, you keep in liquid fund. And whenever you need to withdraw the money, you can always withdraw the money. Point coming out to your the comment section that in case of medical emergency, see, normally when you get admitted in hospital, you don't have to pay the whole bill together.
Sure.
You have to only give a deposit amount, right? Which could have been broadly managed with your 1 month expenses, right? You can give that as a deposit money. If you already have a health insurance, then that takes care of your cashless part of it.
Yeah.
Beyond that, one of the effective means of using this one is called a credit card.
Of course.
You can always have a credit card which you can swipe it, because credit card payment you have to do after 30 days or 45 days, depending on your credit cycle, right? So you have a reasonable amount of time to pay for that expenses, and you can always withdraw that money from liquid fund. So one way is that 1 month expenses has to be in savings account. Beyond that, should be parked in liquid fund, and effectively one should have a credit card so that any emergency happens, he can always swipe the credit card, right? And again, repay that money as soon after withdrawing from liquid funds.
You know, I've heard this for over a decade now. This credit card usage for emergency payments is one of the foremost reasons why people like you, advisors, say that you should have a credit card. Of course, it's used for a variety of other purposes.
See, you should always use a credit card. You can say one of the best way to use your effective use of money. But obviously, you should not be spending money from credit card without having that money in your bank account or in your liquid fund, right? So see, credit card gives you 40 days credit-free interest. And in that time, money is working for you. So today, whatever payments I have to do.
Interest-free credit.
Interest-free credit, right? And I always use credit card for all my payments, right? So I pay from credit card. And whenever the credit cycle is due, I withdraw from liquid fund and pay that money. And for that many days, my money is earning interest for me, right? You have to make your money work for you. Right, and this is one of the effective way to use it. So I'm not saying keep on swiping credit card for all your purchases. It depends on where you want to use it. But for emergency purpose, credit card can be a very, very handy tool, because if you always plan for that emergency, then you may have like a good amount of money in your savings account lying there without any interest. And emergency may not happen for, like, ideally if emergency doesn't happen for 2 years, your money is unnecessarily lying in the savings account, earning 2.5%, and on that you also pay tax.
I don't want to talk about this credit card bit just a little more, because a lot of people are using this to max out the points that they're earning, because effectively it's free money is the way that they're thinking about it, right? If they consolidate the expenses of, say, 4 people and say, I'm going to swipe my credit card, you pay me for it, which a lot of people do, because they're earning a large amount of points, and then they can take that one trip free, or they can get those 2 airline tickets free over the course of the year. But in that sense, what they're doing completely negates what you're suggesting, because if just by chance, and I hope this doesn't happen to anybody, they've swiped their card and they've maxed their limit for that particular month, they don't have access to it in the case of an emergency.
See, you should always keep some limit in your credit card empty, which can be used for emergency. But say, for example, you have maxed out your spending, you can immediately pay for that much money back in your credit card, and limit get open up again. So I use credit card very, very handsomely, right? For all my payments, I use credit card. Recently, I went to Singapore. Most of the expenses was paid by my reward points, and I hardly paid anything for that, right? So today I pay my GST bill from my credit card, right? I pay my income tax advance tax payment from my credit card, right? And I get the reward points, which can be used to buy for me the airline tickets. And so it's very, very easy way and good way to use your credit card. But obviously you can't max out. So if my limit is X amount of money, I don't swipe all my money for all the expenses. I always keep some limit.
Is there a buffer that you keep, something that you have in mind?
Yeah, so depending on your credit, depending on, say if your limit is say 3 lakh rupees, I'll say always keep 50 to 60,000 rupees amount which is not used, so that can be used in case of emergency.
By the way, we had a conversation about this on an earlier episode of MoneyWise, so make sure that you check that out. But we've veered a little bit away from the original conversation. Let's come back on track, which is, you talked about utilizing a credit card for emergency payments and having 1 month of expenses in your bank account. Now, and you've also said that you should have an emergency corpus, and you said liquid funds is the way to go. But a lot of people have spoken to say, hey, you know what, Alex, I can't put that kind of money. 6 months worth of expenses is a very large amount, especially when I'm starting out. What is the solution there?
Okay, so Alex, as you rightly said, you can't build the corpus in 1 day's time, or suddenly you can't build the corpus. Now, liquid fund corpus, the emergency corpus has to be built over the next 6 months to 1 year. Right? So when we meet a client, we say that, okay, over next 1 year, let's target to make your emergency corpus. Now, how do you make your emergency corpus? Right? A lot of people come to me and say that, Nikhil, I can't do saving. Right? I see the money in the bank account, I keep on swiping my card, and I can't save the money. So what I always say that SIP in liquid fund is one of the best way to have a forced saving. So what I always tell people that, okay, you get your money on 5th salary on 5th, let's make a SIP in liquid fund on 7th of every month. Right? The money will be debited from a bank account and invested in liquid fund. Suddenly you need this money, say by the end of the month, by 26 or 27, you have used all your balance. I don't have money, you need some part of the money back. So you can always redeem from liquid funds.
And the next day you get it.
And the next day you get it. So you can use in that way. But say, for example, because you don't see any money in a bank account, you try to say that, okay, I don't spend that money, right? And if you keep on doing this SIP in liquid fund for next 12 months, say 10,000 rupees SIP for next 12 months, you effectively build a corpus of 1.2 lakh rupees.
Right.
That can be used for emergency corpus, right? So I always say, start a SIP in liquid fund. Say you have started a SIP of 10,000 rupees. At the end of the year, at the end of the month, you need 2,000 rupees back again. You can always withdraw 2,000. 8,000 remains in liquid fund.
Yes.
And like that, you do a forced saving. And I've seen that a lot of people over the next 1 year period, they build their emergency corpus.
Okay.
Right.
So the emergency corpus is an absolutely must-have thing, but it's an ongoing requirement. And there are several things that you need money for in an ongoing manner, right? And short-term goals also would effectively require you to save differently from what you would normally do. And we often talk about equity being the best option available, even if it's a simple index fund. But we don't talk about investing in short-term instruments or for short-term purposes. How do you define short-term though? That's a question that a lot of people ask. I've heard it said 3 years or less. Why 3 years though?
Okay. So first of all, not all our money is for long term.
Yes.
Right? We will have different milestones throughout our career, right? Yeah. After we'll have some milestone for 2 years, some milestone after 4 years, and so on and so forth. You can't wait for 10 years for every goal.
Of course.
Right? So you will have different goals coming in throughout your tenure. So what we always said, first write down all your goals, right? You will have goals which is 10 years, 15 years, which is your financial freedom, kids education. And you'll have short-term goals like a vacation, buying a car, paying a school fee. All these are short-term goals. So you need to divide your money in both the buckets. The money which I require for long-term, where equity is one of the preferred option. The money which you require for short-term, the main option here is protection of capital.
Yes.
That I don't want capital to be impacted. Second thing I need is liquidity, that I can be able to withdraw this money whenever I need, right? And it should be not too much volatile. Right? So that's a minimum requirement when it comes to short-term instruments. Now, how do you define short-term, or why 3 years?
Yeah.
So it's a 3 to 5 years, right? So why we say 3 to 5 years? Because markets can remain volatile for very long period of time. So 3 to 5 years. And if you invest in equities all your money and say the markets are down, right? And if you have to, and we have goals come that point of time, you can't withdraw from equities. So that's why we say that at least any money which you require for next 3 to 5 years should not be in equity. It should be in either hybrid or a safer assets, which is where short-term goals comes in. Now, why 3 years? Because we have seen if you take a Sensex rolling return for 3 years, right? You will have like 70-75% time you'll make positive return, but 20% time you may make negative return also. So that's why you can't invest in anything which is for less than 3 years in equity as an asset class.
Because there's always a possibility that when you need the funds, it could be that 20% of time when the markets are down.
Markets are down, and that time you can't withdraw the money, and your goal is there. You have to go for the goal.
Now, when you're talking about investing towards those goals, you've said that capital protection is the primary objective. You talked about your emergency fund, and you only said liquid fund. When I said that other options are there, you went back and you said only liquid funds. There are several options here. There is the arbitrage fund, which I think a lot of people are gravitating towards because of the tax aspect. We'll talk about that in a bit. There's the income plus arbitrage fund, which is effectively a fund of fund kind of structure. And again, post the budget, because of the changes in the taxation and the tax treatment on capital gains, this has become a more attractive option. Why are you saying only liquid funds for the emergency corpus?
So first I discussed that liquidity is the most important aspect here. Yeah. In liquid fund, I can withdraw the money in 1 day's time. Yes. So if I redeem redemption today, next day morning 10 o'clock, money is in my bank account.
Right.
Whereas in arbitrage fund or a income plus arbitrage, it will take T plus 1 day.
Okay.
So it will take a slightly longer time frame to get my money back. Okay. That's the first thing.
Right.
Second, the thing is that in an arbitrage fund or an income plus arbitrage fund, there will be slight volatile, because in arbitrage fund, only by the month end, the cash price and future price become same.
So let's back up a little bit. What is an arbitrage fund? How does it work, and why is it gaining so much traction?
Okay, so what is arbitrage fund? It's a risk-free instrument, right? What you do in arbitrage fund is, say for example, in a stock market there are two markets. One is called cash market, and one is called futures market.
Yes.
What is cash market? You do a transaction today.
Yeah.
Future market is you are agreeing to everything today in terms of terms and condition. What price you're going to buy, when you're going to buy, but the transaction will happen sometime in future.
Sure.
Right? So you fix everything today. So say for example, today Reliance stock price in cash market is trading at say 3,000, and in futures market it is trading at 3,100. So what you do is that you buy in cash market today, and you agree to sell in future market after 1 month at 3,100.
Sure.
So effectively you have bought at 3,000 and you already sold at 3,100. You lock your gain of 100 rupees on the stock.
Right.
Right. So, and last Thursday of every month, the cash market price and future market price become same.
It converges.
It converges. So then you don't make, so if whatever gain, if you made money gain in cash market, in future market will make a loss, and effective gain will be only 100 rupees.
Sure.
Which you have logged in initially.
Right.
Itself. So now, so that's an arbitrage fund.
Yeah.
So every time they do a transaction, buy and sell at the same time, you lock in your price, and last Thursday of every month, because both converge, your effective gain is what is the transaction you've done on the first day.
Is there at all any potential for capital loss in an arbitrage fund?
No. So if you're holding for the whole tenure, which is like 1 month and above, there's 0% probability or very low probability of making any negative return.
Okay.
But in between, what happens is that you may have logged in 100 rupees gain.
Yeah.
But in between, the price can go up and down.
Right.
Right. And because of that, there can be slightly lower return or higher return based on which you have agreed at that point of time.
Sure.
So in interim month, there can be slight volatility.
Which is why you should not use this.
You should not arbitrage fund for a very emergency purpose.
Right.
Ideally, you should withdraw from arbitrage fund at the month end so that the cash market price and future market prices converge, and you're not taking any undue volatility of the interim month.
And is the time holding for an arbitrage fund ideally longer than a liquid fund? Should you be willing to hold for longer?
Ideally, you should be investing in arbitrage fund for 3 months and above.
3 months and above.
Right.
Okay.
In liquid fund, you can invest for any time frame. Right.
Okay.
You can invest today, and after 10 days you want to withdraw, you can use that liquid fund.
Is there a dramatic difference in the strategies that various mutual funds operate in the arbitrage category? Can there be a big variance in the returns that they offer you?
No, there won't be too much of variance. There can be 10-15 basis point differential. It is because of amount of money you are willing to bet on, how fast you are able to do the dealing part of it. So there are a lot of other technical indicators which will make a slight difference in the returns, but there won't be too much of difference.
Are they always better than liquid funds in terms of return profile?
See, return profile can be very much similar to liquid fund, but on the taxation, it makes a huge difference.
Yeah, because if you're holding for more than a year, it becomes long-term capital gains for equity.
And
which
even
is
if you're holding
12.5.
for less than 1 year, it classifies 20% capital gain.
Yes.
As a short-term capital gain.
Yes.
Whereas in liquid fund, you pay as per tax bracket.
Yes.
So if you belong to 33% tax bracket and above, you pay as per standard tax slabs.
Yes.
Which is far higher than an arbitrage fund because there's only 20% or 12.5% depending on your tenure.
Now, and the third option available, which we've just discussed, is income plus arbitrage. It's in that fund of fund structure, and the tax treatment of this, correct me if I'm wrong, Nikhil, is 2 years if you hold, it becomes long-term capital gains, it gets taxed at 12.5%, correct?
Right.
Which is why a lot of people are gravitating towards this, and I think a lot of mutual funds have launched these schemes.
Yeah. So basically, earlier what people used to do is that people used to invest in debt fund with a longer horizon. Yeah. And the benefit was that if you're holding in debt fund for more than 3 years, early you used to pay long-term capital gain, which is with indexation 20%.
Yeah.
So effective return tax was like 7-8%,
right,
and was far lower than your fixed deposit.
Right.
Now with the new with the new regulations,
right,
now your FD interest and a debt fund interest, right, both are taxed at your tax slab.
Correct.
Right. So there's no tax arbitrage between a debt fund and a fixed deposit. So now there's a new category of fund. What Government of India says that if you're investing in a fund which has got 35 to 65% equities, right, then that fund, if you hold for more than 2 years, you classify under long-term capital gain and you only pay 12.5% tax, right? So now what happens is that a lot of fund houses are launching a fund which invests 65% in debt funds and 35% arbitrage. Okay. Now arbitrage is classified as equities. So and there's no risk. So his return profile is as per debt, but taxation as per equity. So because you're investing 35% arbitrage, you classify under the new structure where you pay capital gain of 12.5% if you hold for more than.
Is it 35% arbitrage or 65% arbitrage? So it's anywhere between?
Anywhere between 35 to 65. So if you have that bracket, you classify under long-term capital gain. So now a lot of fund houses, what they're doing is that they are predominantly doing a debt fund, which invest up to 35 to 65 in debt funds and remaining arbitrage. So your risk profile is as like a debt fund.
But why is it a fund of fund structure? Because they're investing in their own liquid funds.
They're investing in their own arbitrage fund and they're investing in their own debt fund.
Okay.
Now here the fund house can take a call whether when he likes long-term debt, he can invest in long-term debt. When he likes short-term debt fund, he can invest in short-term debt fund. So there the fund house has the ability to maneuver between short-term and long-term debt fund. And the good part is that here you don't have to manage the debt portion separately. There's a dedicated debt fund which is already managing that portion.
But these are costlier than your pure liquid and pure arbitrage. Is that right?
Yeah, it will be slightly costlier because there are two structures here, right? One is there's the underlying fund expenses, and over and above there's the main fund expenses. But effectively the overall cost will be slightly higher than the if you go plain vanilla debt fund or plain arbitrage fund, but you can't have your own structure like that.
So between the three, and you're talking about liquid, which is purely for emergency, etc., but the tax is not as good as your arbitrage fund, and not as good as your income plus arbitrage fund. How do you use these three? You already talked about arbitrage. how do you use income plus arbitrage?
Yeah, so anyone when you're looking for a 2-year time frame, so as we discussed earlier, not all your goals are long term, and not all your goals are emergency. Right. So you have goals for short, very emergency purpose, which you can use liquid fund. You have goal for like 3 to 6 months or 1 year. You can use arbitrage fund there as an option.
Yeah.
If your goal is like 2 years down the line, you want to plan for your international vacation, or you want to buy a car or a bike or something, any expensive thing, right? So then you have a 2-year time frame. Then you can use income plus arbitrage fund. So any goal which is above 2 to 3 years, that is the sweet spot where instead of doing a fixed deposit, you can do an income plus arbitrage fund where return may be similar to a fixed deposit, but because you save quite an amount of money on the taxation. So it can be a very, very effective tool for people looking for 2 to 3 years. Instead of doing 2 to 3 year goals, instead of doing an FD, income plus arbitrage fund makes sense.
And so these two options are certainly better than a fixed deposit because of the tax treatment of them. Now, beyond what we've spoken about, and we've spoken about 3 options for this sub 3-year goals, right? Is there anything else that people should consider investing in that qualify for everything we've spoken about?
Yeah, so one more thing, but before coming to that, apart from tax benefit, what income plus arbitrage fund can also do, right? So lot of income plus arbitrage fund can invest in long-term debt fund also, right?
Invest in?
Long-term debt fund also.
Right.
Now, when you invest in long-term debt fund, and if interest rate comes down,
capital gains.
Your bond price goes up, and you can make capital gains. So if you look at last 1 year, right, your long duration fund would have given you return in the range of 8 to 9%,
right?
Whereas your fixed deposit is only 7%. So since you are in the falling interest rate regime right now, right, apart from the tax arbitrage, if interest rate really falls further, because with the recent inflation number at sub 3%, if interest rate falls further, you can make capital gain also.
Sure.
So from those perspective also, that you can make slightly better than fixed deposit, and you also save on taxation. So that's why income plus arbitrage fund makes sense.
But any other instrument?
Yeah. So apart from that, there's something called equity savings fund.
Sure.
Right. Now, arbitrage fund, liquid fund, and income plus arbitrage fund are pure like a debt structure.
Yes.
They don't invest in naked equity exposure.
Yeah.
They invest in arbitrage, but that's like a risk-free instrument.
Yeah.
Now, equity savings fund have a 10% to 40% equities. Right? So if equity market does good, right, they have a naked exposure. If some fund house may have 10%, some fund house have 20%, 30%, depending on your every fund house's strategy.
Yeah.
So they invest 10 to 40% in equities and remaining in debt or arbitrage.
Right. So a couple of questions here. Income plus arbitrage relatively new in terms of the popularity of these schemes are getting a lot of inflows. But do we have enough data to say that is there a big variance between the performance of these schemes?
See, most of these funds have been launched for last 1 year, 2 years.
Sure. So we don't have enough data.
We don't have enough data. And second thing is that right now, when you're investing, these funds may show you very better return as compared to debt fund. The reason is because, as I discussed with you, that in last 1 year, interest rates come down.
Yes.
And these funds have invested in short-term debt fund or long-term debt fund. And because of that, they have made a slight capital gain.
So how do you choose the right fund?
See, so again here you have to look at the fund houses, right, and understand their philosophy where they're going to invest the debt component, and the arbitrage is fairly simple. So how they are going to manage the debt component, and based on that invest in that fund. So predominantly right now you don't have too many history to check which fund house has done good.
Yeah.
So and as I discussed, there won't be too much of variance, right? But yeah, here the skills depend on debt fund manager.
Yeah. Okay.
That how good he was able to move between long duration and short duration, right? And that will determine the performance. But looking at only the past return of last 1 year
is not going to tell you what to invest.
Is not good to you, because this fund may show you better return because interest has come down and because you made a capital gain.
Okay. The last aspect that I want to discuss today, Nikhil, with you is the tendency that a lot of people have to keep their investments in equity. And of course, you should invest in equity and don't touch it to allow that the compounding to take place. But ultimately, when you're nearing your goal, you need to move out, right? But how do you do that? And here's where systematic transfer plans or systematic withdrawal plans come into play. Why are they so powerful?
Okay, so I'll give you a real story in this one.
Yeah.
Okay, this is with one of our client. Okay, when you do planning with the client, right? You have goals, and say when you started your investment, the goal was like say 10 years down the line, 7 years down the line. So you invested in equity fund because the goal is 10 years down the line for the kids' education. So you invested in equity fund. Now, after 5-7 years, after 7 years, the goal is not 10 years again.
Yes.
The goal is only 3 years down the line, right? So what you need to do is that you need to move from equity fund to a conservative funds.
Right.
Right. So that even if market falls tomorrow, you clearly have a goal, right? And you have to pay for that. So this is an example of one of our client. So the client's daughter was going for US education. And in US, normally you have to pay fees in July, August, right? And in 2020, the client called me up.
Yeah.
That was in July. And he said that, Nikhil, I need money for my daughter's education. So I'm saying, fine, you can withdraw at any point of time. He said, no, I know I can withdraw at any point of time, but markets are down.
Yeah.
And my portfolio will see a negative now. So how do I pay for it? I'm saying your daughter was going for education is not known to us today.
Right.
We've been planning for such a long period of time.
Right.
So the money which you require for this year as well as the next year is already kept in debt or a arbitrage fund.
Sure.
Right? And that money has not got any impact with the equity market falling down.
Right.
The money which you require after 2 years or after 3 years, third year and fourth year, that money is in equity and that has fallen. But that money you don't require now. You require for 3 years. So why are you worried about it? And he felt so good about it that because you move money from my equity fund to a conservative fund when you come closer to your goal. So this is very important for everyone that not all your money can be in equity all point in time. Once you're nearing to your goal, you need to move your money from equity to conservative funds. So that's where the income plus arbitrage fund or equity savings fund or a pure arbitrage fund makes a huge difference.
So the last question to you, which is when you hit retirement, and a lot of people have equity savings for a long period of time, but when they do hit that retirement goal, how much should they transfer on ongoing basis into your more conservative investment? Something to take care of the next year, is it?
No. So in retirement, I always say you need to follow a bucketing approach.
Sure.
So the money which you require for first 3 years, that money should either be in debt or an income plus arbitrage fund.
Okay.
The money which you require from third to fifth year, that should be in equity savings fund.
Sure.
The money which you require from fifth to seventh year, that should be in hybrid fund.
Sure.
And money which you require after seventh year, that should be in equity fund. So when you're closer to retirement, you need to keep on bucketing your this one. And that has to go on every year on year. So because once you're at 60 and you're retiring 60, you should have 3 years expenses in a debt fund or a income plus arbitrage fund, so that even if markets have any impact, because you're withdrawing every month on month, you don't see any impact of market.
But do you do this in the run up to 60 or at 60?
Okay, so
I mean at retirement.
So you start doing from 58 and 59.
Sure, before.
Right? So any inflows you're getting on 59 or 60, you don't put that money in equity.
Right.
You try to make that bucket for next 3 years.
Got it.
Right, and then the remaining money can be in long term thing. And once he's retired, and every year you need to keep on moving from equity fund to a conservative fund, so that at any point of time, you should have your 5 to 6 year expenses in a conservative funds.
And so that STP or the systematic transfer plan can be something
it
that
can
you
be
can
very,
use.
very, so systematic transfer plan should be used to move money from aggressive fund to a conservative fund, and SWP should be used to withdraw from conservative fund to his bank account.
Fantastic. All right, Nikhil, thanks so much for joining me today.
Thank you.
Absolute pleasure having you.
Thank you. Thanks a lot, Alex.
All right, so we've discussed several practical ways for you to manage your cash flows, irrespective of where you are in life's journey. Let us know what you think, and if you have any personal experiences that you'd like to talk to us about. That brings us to the end of this edition of MoneyWise. This is NDTV Profit.